All right, good evening, everyone. Please keep yourselves on mute while you're in here, unless you need to ask a question, then take yourself off mute to ask any questions, and feel free to interrupt me as we go through the presentation tonight. We're going to talk about bond financing this week, and then next week, chapter 11, we're going to talk about financing with stock and stock issues. But for tonight, we're just going to focus on bonds. And as you can see on the screen, that the life of a bond is a considerably long length of time. We looked up one in my class the other night on Thursday night, and the one we were discussing happened to be a 25-year bond. So they really vary. It depends on what the contract says. Bonds are issued as a contract. So if you buy a bond, you're agreeing to pay a certain amount for it if you're not buying it on the market. And we'll talk about the market in a minute. And then you're going to be paid out interest during certain intervals. You could be paid interest annually, you can be paid interest monthly, quarterly, or semi-annual. The norm is semi-annually, so that's what we're going to be looking at tonight. You can see that the interest payment that you're going to receive is going to be based on the par value of the bond, and that's the what it's issued at. And then there's a contract interest rate. So if you're buying a $10,000 bond that's going to mature in, let's say 2042, and it's 8%, you're going to get an 8% payment on that throughout the life of the bond. Until now you get, and then you might decide to sell it early, you might decide to keep it until the bond matures, and then you'll be paid the full amount of the par value. It will not include interest, because you've been paid interest as you go through the period of time that the interest is paid. Okay, so that's kind of a difference from what we're talking about with notes payable and notes receivable. And there's advantages and disadvantages to bonds. You're going to get into higher level accounting courses, or you're going to actually analyze what's the best way to finance projects. And you're going to look at whether it's going to be bonds or stock, or taking out a loan from the bank, or a mixture of all of these things. And you'll analyze based on what the market risk is and the risk in the investment. And you'll compare that way. And so, as we can see, bonds don't affect owner control. Stocks do, because if you buy most types of stock, there are types of stock you can't vote, but most types of stock you get a vote, and bonds you don't get a vote in the control of the company. Interest on the bonds is tax deductible, which is an advantage that a lot of folks see in buying bonds. And bonds can increase your return on equity. And so, and that goes into the financial formulas that we have been learning in this class. You'll see how you can manipulate those by increasing the amount of debt financing you have, or increasing the amount of equity financing that you have. Now, here's the thing. The disadvantages are you're required to make periodic interest payments, okay? And you're required to pay off that bond at maturity. If you don't, you're in default, and that can financially destroy a company, all right? So that's important to keep in mind. And what most companies do is they have what's called a sinking fund. And so they'll put away money periodically into the sinking fund so that it grows in value. And by the time their bonds become due, that they'll have the money to pay them off. Kind of like you're putting away into a savings plan, the entire time that these bonds are out there on the market. And they, just like they can increase return on equity, if they're not handled the right way, they can decrease your return on equity. And again, this is an important financial measure that people are going to look at on deciding whether or not to invest in your company or your projects. Now, the way bonds are listed on the securities market, it's a little strange, okay? Because I've been talking about bonds in $1,000 increments, right? Which is the norm. But when you go to look up the bond price, all right, a bond sold at par is going to sell at 100. Okay. So as we can see here for IBM, they have a stated interest rate of 4%, which was, at issue. That's a contract interest rate. It's going to mature in 42 months. The yield is 3.81. Now that tells me right there, this bond's trading at a premium. All right. It's trading higher than what the par value is. There's an inverse relationship between price and yield. So as the yield goes down, that means the price of the bond's going up. So if you bought this bond at its stated interest rate of 4%, and then a couple of years later, the yield's down to 3.81, well, you can make some money on selling that bond. And a lot of bond traders that are good can make a considerable amount of money trading bonds when they go up and even when they go down by selling them short. You can see that there has the volume of how many bonds are traded. That's usually in thousands. Okay. And then it gives a percentage change in the closing price. So the closing price of this bond, if it's $1,000 bond, is actually $1,000 and, to round it off, $31. Okay. That's what you're going to buy this bond for at what we're looking at here on this slide. So we'll look at some examples. All right. Our first example is when a bond is issued at par value. Company issued the following bonds. Par value is $100,000. The stated interest rate's 8%. It matures twice a year. I'm sorry, interest rates are paid out twice a year in June and December. And the maturity date is December 31st, 2023. Now, that was done for simplification purposes. Most bonds are either 10-year, 15-year, 25-year bonds, okay? As you can see, when the bond is issued, we're going to debit cash, $100,000, and we're going to credit bonds payable, $100,000. And because we're carrying as a credit, it's going to be carried as a liability, long-term liability. Now, issuing bonds at par and determining what their interest is. So on June 30th, 2022, we're going to make its first semi-annual interest payment. How do we calculate the interest? We're going to take the $100,000 par value times 8%, which is the stated interest rate, and then we're going to divide it in half or multiply it times 0.5, and that gives us $4,000. So we're going to debit bond interest expense, $4,000, and we're going to credit cash, $4,000 to make the annual interest payments. On December 31st, 2023, the bonds mature. The issuer of the bond pays the face amount of $100,000 to the bondholders. Very easy. It's going to be a debit to bonds payable, and that removes them off of the liability section. And we're going to credit cash $100,000 to pay them off. This is an important exhibit you want to bookmark in your books, all right? Because as you work problems, you're going to need to refer to this more than likely, all right? As you can see in this slide, when the bond is set to go on market, it has a contract rate. Once it hits the market, then the market gets to adjust what the real interest rate is that's going to be paid on the bonds. So if the market rate is less than the contract rate, the bond sells at a premium. And that was the example we saw with IBM a few slides ago. If the market rate equals the contract rate, it's selling at par. And if the contract rate is less than the market rate, we say that the bond is selling at a discount. And so when a bond sells at a discount is when you lose money. So if you buy it the first day it's out there and it's selling at par, and then a week later interest rates change, then the value of that bond can go down. Now, what would cause interest rates to change? How about what we're going through right now? Inflation. All right. That's a factor. Also, the Fed just told everybody they're going to start raising interest rates. That's going to affect the bond market. So, and as we're going to learn next week, it also can affect the preferred stock market because they act a lot like bonds do. So this is important that you understand this. And that's why I say this slide will be, I'm sorry, the exhibit in your books, 10.3, will be handy. All right, so we're going to look at a couple examples next that deal with the discount and premiums on bonds. So the first example is company issues bonds with the following provisions. Par value is $100,000. The issue price is $96, 96.4, I'm sorry, percent of par value. So that means when we issue it, the market has decided that the market rate, I'm sorry, the stated interest rate is not correct. And so they're going to adjust the interest rate to what the market wants it to be, and that's 10%. You can see in the example, the interest dates are June 30th, December 31st. The bond date is December 31st, 2021, and the maturity will be December 31st, 2023. Because the market rate is greater than the stated interest rate, it's going to sell at a discount. How do we calculate what that discount is? Well, as we can see here, we're going to take the par value of $100,000 and then take the cash proceeds, which we saw before. Remember, it was 96.4%. So that translate into the proceeds we're going to collect when we sell the bonds will be $96,400. That means our discount is going to be $3,600. And you can see how it's calculated on the slide. So when we go ahead and we have to do our journal entry, then on the journal entry, the first thing we're going to do is we're going to debit cash for the amount of the cash we actually received, which is, it is $96,400. We're going to then debit discount on bonds payable. It's a contra liability account that's attached to the bonds account. And then we're going to credit bonds payable $100,000. And the reason why it's $100,000, even though we sold those at a discount, we still got to come up with $100,000 in 2 years when these things mature. The fact that it's sold as a discount doesn't change what the contract says we have to pay. Contract says we have to pay par value in all cases, whether we sell at a discount or a premium. So one of the things we're going to have to do is we're going to have to recapture this discount over time. So how do we do that? Well, and this is kind of hard to read. It's real small, but it's in your book. It's exhibit 10.6. We're going to take the total bond interest expense over the 4 payments, because remember, we're going to pay out interest 4 times over the next 2 years. And then we're going to divide that by 4. So it happens to be $19,600 divided by 4, and that comes to $4,900. How do we get to 19,600? Well, we take the 4 payments that we're going to make, which are $16,000. All right, 4 times 4,000, 16,000. All right. Then we have to add in the discount, which is $3,600. That's how we get $19,600. So when we go to do the journal entry, okay, every time we make an interest payment, we're going to have a debit the bond interest expense of $4,900. We're going to credit discount on bonds payable $900. Reason why we're doing a credit is because the normal balance for discounts on bonds payable is a debit. Remember, it's a contra liability account. So it's contra to the credit. That makes the normal balance a debit. And then we're going to go ahead and we're going to debit. I'm sorry, not debit. We're going to credit cash $4,000. If you total both columns, you'll see that both equal $4,900. Again, a good exhibit to make sure you bookmark for when you're working your problems, okay? This is a chart that shows you essentially what the carrying value is so that you can track what's happening to the unamortized discount as you go through the different payment periods. As you can see, when the bond's issued, you start off at $3,600, and every time you make an interest payment, it goes down $900 until the last payment is made and you're paying off the bonds and the unamortized discount goes down to zero. So what do we do if we sell at a premium? Well, what we do is, in our example, we have a par value of $100,000. The issue price turns out to be 103.6 instead of 100. Okay, remember when it sells for more, it's called a premium. The stated interest rate is 12% on the contract, but the market says we're going to drop that down to 10. And that could be for a variety of reasons. It doesn't necessarily have anything to do with the company. It can just be the way, and a lot of times these initial rates are determined months ahead of it being put on the market, and a lot can happen. Russia can invade Ukraine. Okay, so the stated interest rate we're locked into from a month earlier all of a sudden changes. All right, so I mean, this is, if you want to find out more why, study the markets and how the markets operate. So anyway, interest rates are the same, bond date is the same, maturity date is the same. Now here it's going to be a little bit different. Okay. We have another adjunct liability account called premium on bonds payable. This happens to have a normal balance of a credit. So what we'll do is when the bond is issued, we're going to debit cash $103,600. We're then going to calculate what the premium is, and that happens to be $3,600. So that's going to be a debit to premium on bonds payable. And then we're going to credit bonds payable for $100,000. So now we have, in this particular transaction, one debit and two credits. We're going to work this account down the same way we did the other one. Again, you can see how it's structured. I'm going to skip ahead. All right, so in calculating, how do we come up with our bond interest expense? Because it's going to be different. We're still going to have 4 payments of $6,000. And that's going to equal, in our example, remember, it's different percentages here, so that's why it's not coming out the same in numbers. But we're going to have 4 payments of $6,000, okay, which happens to be 12% of 100,000 divided by a half. So the total number of payments we're going to make is $24,000. In this case, instead of adding the discount like we did, we're going to subtract the premium. So it's the opposite of what we did in the other one. And that's going to bring our bond interest expense that we get to capture each time, or get to calculate to capture each time, is $20,400. We're going to take that $20,400, divide it by 4, because we have 4 interest payments, and each bond interest expense is going to be $5,100. Well, we're $900 short of the $6,000 cash payment. That's going to be a debit to premium on bonds payable. That's how we amortize that amount to go down to 0 by the time the note matures. And we'll see that hopefully in the next slide. Yeah, there's our table. So you can see that we're essentially doing the same thing, taking the unamortized premium that we paid, $900 each payment period down until it gets to zero when we pay out the par value of the bond. Okay. Again, bookmark these exhibits. Make sure you have them handy when you're and so that you can help keep it straight and you're not adding when you're subtracting and vice versa. Now, bonds are sometimes retired. Now, let me talk for a minute about this. Why would you retire a bond? Well, sometimes, bonds are contracts. So just like any contract, you have certain things written into the contract that can happen. Not every contract says that, the company won't cash out until the end of the maturity. Sometimes they will give reasons when they can go ahead and buy back their bonds. That means they're calling in their bonds. All right. Some bonds can be converted to stock, usually preferred stock, sometimes common though. Sometimes you get to decide. Sometimes the company gets to decide. Just depends on what's written in the contract. You got, if you're going to buy a bond and it's important you read the contract and see what the rules are for what you're buying. Because again, most of them are basically the same, but you might decide to buy a bond that's a little bit different, and you might sit there 2 years after you buy the bond and it ends up getting called and you're getting a check for what they owe you. So let's look at an example. There were on the bonds that we just talked about, $100,000 bonds by FILA. They decided that they're going to retire them. So what happens when they retire and there's no premium or discount to worry about, it's relatively easy. It's a debit to bonds payable, and that takes them off the books, and a credit to cash for $100,000. If the carrying value is greater than the retirement price, you have a gain. Same as on income, you made money, it's income, you got to pay taxes on it. If the carrying value is less than the retirement price, you have a loss. So in our example, we assume $100,000 of callable bonds will be retired on July the 1st after the first interest payment. The bond carrying value is $104,500. The bonds have a call premium of $3,000. Okay. So as we can see how we're going to set this up, we're going to debit bonds payable, and that takes the bonds payable off the books. The current value because the carrying value is 100,000, you subtract 100,000 from the carrying value, and we have a premium on the bonds that remains of $4,500. That's going to be a debit to premium on bonds payable, because when we wipe out the bonds, we have to wipe out the premium account that we're carrying on that and amortizing. All right. And then we're going to credit cash 103,000 because there's a premium that's paid. It's written in the contract. Got to pay a premium when we call them in early, and that happens to be 103,000. Now, if you add up the debits and the credits, we come up $1,500 different. We need to add a $1,500 credit. Because it's a credit, what is that the same as? Sales. So that tells us we have a gain on retiring the bonds. Now, if it was a debit, we wouldn't even have to look. We know that that's a loss, because whenever we have a loss and we write it off on the books for any reason, okay, if you go back to when we talked about depreciation, we looked at losses. That was a debit, right? So, but in this case, we have a gain. Gain's the same thing as a sale or revenue. And so we're going to credit gain on bond retirement, $1,500. And the way I laid it out, the reason why I jumped down to the cash we received and then calculated the difference, it's an easy way for y'all to figure out whether or not you have a gain or a loss. All right, we have something called long-term notes payable. And what this is, Similar to a mortgage. When you make a payment to a mortgage company or a car loan, you're making a payment that includes both principal and interest. Well, how do you know what the principal is and how do you know what the interest is? Well, we're going to learn how to do that in this one. All right. So what we're going to look at doing here is we're going to have to go to an annuity table, but we're not going to actually go to that in the homework. We used to a few years ago in this class, we'd send you to the tables and you calculate it yourself, but not anymore. I believe all the homework and quiz questions will tell you what the table value is, and you just have to run the calculation. So in our example of installment notes, Fog Hog, that's a neat name, borrows $60,000 from a bank to purchase equipment. It signs an 8% installment note requiring 3 annual payments of principal plus interest. Now, notice it doesn't give you the payment. The payment's what we're going to calculate. So, as you can see in the table below, it gives you how we're going to calculate this. We have the principal divided by a present value factor. The present value factor happens to be 2.5771. When you go on to other accounting classes and finance classes, they will teach you how to use these tables and how to calculate that, because you actually can run a mathematical formula to get to the same thing without having a table. The present value, as we can see, is $60,000. That's what we borrowed. And so each of the 3 payments, if we divide that 60,000 by 2.5771, will give us a payment of $23,282 for the life of the loan. Now, you're thinking, well, what about that 8%? Well, if you go to the table, you'll go across the top of that table until it says 8%. And then you'll go down 3 rows because we have three payment periods. And that will give us the factor. We'll see that factor on the table. Again, we have a handy chart, exhibit 10.12. Definitely need to use this when you're working this problem because it'll help keep you straight. So you start off with a beginning balance of $60,000. You then have to calculate what the interest is on that for that first payment. So the interest on that first payment is going to be $4,800, which is 8% times your beginning balance. And it says it right there in the chart, 8% times column A. And it says that's going to be our debit to interest expense. You see that right above it? So it's telling us what our journal entry is going to be. It's telling us what our journal entry is going to be. It's telling us how we calculate that particular column. Then we go to column C. We see that column C is we have to take column D and subtract B. Now, you're saying, well, how do we know what D is? Well, we already calculated that. It is the payment that we're going to be making. That's going to be our credit to cash. So we can just, when we know what our payment's going to be after doing what we did on the previous slide, we can fill that in ahead in all 3 rows. So we're going to take D minus B, 23,282 minus 4,800, and that's going to give us, wait a minute, hold on. Oh, that's going to give us 18,482. I lost my place. I was looking over at ending balance. So if we take the $60,000 and we subtract C, which is the principal, okay, A minus C gives us our ending balance for that row. Whatever's in column E for that row goes down to the next row in column A. So as you can see, we start off with 41,518. Multiply that number times 8% gives us 3321. We subtract 23,282. We subtract from 23,282. the 3321, and that gives us our principal payment of 19,961. So again, we subtract C from A, and that gives us an ending balance of 21,557. 21,557 becomes the beginning balance in row 3, and we go through the whole process again to get to 0. Pretty straightforward. But again, you got to follow the rules and just take it one step at a time. You take it one step at a time, you're going to get to the correct answer, and you'll stay out of trouble. Here we see the 3 journal entries. Again, go to the table. The table tells you what the journal entries are. It says what your interest expense is, okay? It says what your notes payable debit is, all right? And it's going to give you your credit to cash. Credit to cash isn't going to change for all these 3. The 2 things that are going to change is what you capture as the interest expense and what you capture as the note payable. All right, you can read the screen, see what it says about mortgages. Basically, a mortgage, you're putting up an asset as collateral so that if you default on the payments, you lose the asset. Okay, so here we have the features of bonds and notes. You have both secured and unsecured bonds and notes. Okay, I've not really come across any bonds that are secure, but it's possible they could be. All right. Bonds are, by the way, if a company declares bankruptcy, the people that hold the bonds are in a better place than the people that have preferred stock and common stock. All right. They'll get paid first. You have convertible. I explained what they are. You can convert them to stock, and they can be called. They can be called in early. And the reason why, again, a company would want to call their bonds in early is because they want to improve their financial position, or maybe they have a windfall of cash and they just want to get rid of that debt. You have term and serial bonds, and you have registered and bearer bonds, although bearer bonds are going away. They used to be a big thing at one time, but federal government doesn't like the fact that they're not registered and can be used to hide money. And this is our formula of the week: debt to equity ratio, which is your total liabilities divided by total equity. You want this factor to be low. You do not want it to be higher. All right. As we can see, comparison against Nike and Under Armour. Nike started out 2 years ago at a 0.87 and then went up to a 1.3 and then a 1.62, showing that there's an increased risk there. Under Armour also went up, but did not go up as much. So it, just another way of measuring how good a company's financial performance is. All right, that's the end of the presentation. I'll open it up for questions, see if any of y'all have any questions that you'd like to ask. Take yourself off mute if you would like to ask any questions. All right. We're going once, going twice. I guess the phrase that you want to put in there is just describe why a company would call in its bonds. And the answer to that would be that they want to improve their financial position. That's the most common reason. Okay. Just put that in the survey. I'll know you watched the video and you get your 100 points. Got 2 more live sessions left, and debating on maybe doing a short session about the final exam. I still haven't made up my mind yet, but we will meet here next Sunday and the Sunday following for the last 2 live sessions. So good luck on your assignments this week, and feel free to reach out to me if you have any issues.